Question 18. Kimberly Roberts has run a business for the past 5 years. She does not have an accounting background and is unsure how to prepare financial reports. Because of this, Kimberly has only prepared 2 income statements since she began the business. Which accounting principle has been breached in this situation? Is it A, reporting period, B, going concern, C, consistency, or D, comparability? Well, D, comparability, is actually a qualitative characteristic, not an accounting principle, so we can get rid of that. In terms of consistency, in fact, she's actually not being consistent at all. However, and consistency is about accounting methods. Just not applying something is not an accounting method. So C doesn't really apply either. So we're going to get rid of C and D. That leaves us with A, reporting period, and B, going concern. Let's look at both of these. Going concern can be very simple, but yet also very difficult to understand because of its simplicity. All it says is the business is assumed to go on and exist forever. So what that means is at any point, so today, we look to the future of the business and we assume it will go on forever, this symbol of infinity. What that means is, or what it allows us to do, is when we buy, say, a building, we don't know the business is going to be around in 12 months' time. However, because of the going concern principle, we do assume it will exist forever, and that means we get to call that building a non-current asset. So whilst the going concern principle is good, it needs something to sort of back it up or sort of make it a little bit more complete. That's where we add in the reporting period principle. What that says is that infinite life that we assume exists forever should really be broken up into periods or reporting periods of equal length. These can be any length you like, just no bigger than 12 months. Then, at the end of each period, we should match or determine our profit by matching all revenues earned against expenses incurred. So let's say the periods here are a year in length. After the first year, we take our revenues minus our expenses to get net profit. Another year goes by, revenues less expenses to get net profit, and so on. So what's Kimberly done? Well, she is not, in 5 years, she has not done an income statement at least every 12 months. So the actual accounting principle she has breached is not going concern. She has breached the reporting period principle by only doing 2 income statements over a period of 5 years. As a minimum, if she's been operating for 5 years, she should have done 5 income statements, not 2. Based on that, we're going to say the answer is Kimberly has breached the accounting principle of A, reporting period.